Academy, and I'm excited to welcome today Clint Korver, of course, the instructor in raising startup capital. He's also the COO of NovoEd, and he's the co-founder of Ulu Ventures, and he's really been on both sides of the table on this investment issue. He's raised money, and he's also invested money in several ventures. He's also a Stanford adjunct professor in entrepreneurship. And welcome, Clint. We're going to jump right into the questions. In the class, you talk about entrepreneurs often leave too much to chance when they're fundraising. What do you mean by that? And isn't a little luck part of the whole process?
Luck is certainly part of the process. And so your goal as an entrepreneur, in my mind, is to take as much of chance off the table as you can. I mean, your job as an entrepreneur is to reduce risk. And in fundraising, there's a lot of ways that you can reduce risk. So one is, I'll just give you a couple of examples, I'm sure we'll dive into more details, but one is to have a portfolio approach to raising funds. So as opposed to just talking to one venture capitalist, you talk to many venture capitalists, you talk to angel investors, and you figure out a way to bootstrap it with no capital. And it's like, from my point of view, you should be doing all of those initially. And then hopefully you get lucky and you raise venture capital funding. But if not, if you're not able to raise any capital, you've got a plan, you've figured out a way to survive without raising much capital. So this is what I mean by taking luck out of the equation.
First-time founders, though, may be a little bit intimidated, by going after venture capital because they don't understand the process. How can they easily determine whether their product, their company is going to be attractive to VCs?
Well, so one good thing about venture capitalists is a lot of what they do is public. So you can go to venture capitalist website and you can see the kinds of investments, the kind of startups that they're investing in. So that's one way to kind of start to figure out, well, do I have something that is investable by a VC? Well, go look at what they're investing in and see if you compare in terms of the market you're going after, the team you've put together, the kind of progress you've made. So that's a way that anybody can have access to this kind of information. A little more specifically, venture capitalists are looking for something very specific when they invest. They're looking for home run kinds of companies that have the potential to go public. So this is not all VCs fit into this category, but probably 80%. So that looks like you've got a market where you could be $1 billion company. So if you can imagine basically drawing a line between where you are right now and being successful in execution to getting to $1 billion company, you've got a story that's potentially attractive to a VC. Now, by the way, most successful companies in the world don't follow that path. Most successful companies, if you built a $10 million a year company that generated $5 million in profit, that's a pretty spectacular company to be associated with. You're not going to get venture capital funding, but you could have a pretty fabulous life and a pretty interesting professional experience with that kind of company. So not all the best companies aren't going the VC route. That's just one path that you could follow.
Okay, we're getting some viewers, and I would encourage people to submit questions. We do have a question already from somebody who was in the forums in the class. Would a VC meet with an entrepreneur if they're just testing the waters, if they're not really actively fundraising? Is it reasonable to try to get a meeting with a VC just to see what their reaction is?
So that's actually a great strategy in general, is to start building relationships with VCs before you need the capital. So great strategy. Then the question is, well, how do you actually implement that kind of strategy? So this is, falls in the category of life's not fair. And so you got to figure out some unfair advantage you have to get in to see these folks. So maybe you went to school and there's a VC that's speaking at your school or has talked to your school. So that's a sort of a reason to have a connection and to be able to go in and talk to them. Another way to get in and talk to a VC is through somebody they know. CEO of a company they funded, somebody else that has a connection to them. VCs are incredibly busy people, and on top of that, they have literally a flood of requests for their time. So for you to actually get their time, you have to figure out how to break through that flood. And so it's a personal connection. It's like I said, you see them in school, you see them in an event, that sort of thing. So if you can go in and do this, absolutely recommend it.
It sounds like just creating some kind of common ground, whether it be the background in business or, like you said, school connections, that sort of thing. Anything that would attract their attention beyond your business, right?
Yeah, and it's a bit of a mystery process actually in terms of how you go get VC funding. It's not like they say apply here and then I mean it's like getting into school, getting into job. I mean a lot of these sort of processes there's a well-known process. With VCs it's not a well-known process, and from the VC's point of view it's not such a dumb thing. It may sound like a silly thing from the outside, but the VCs are looking at you as, do you have the wherewithal to create a company? And that means you're going to have to find customers, you're going to have to recruit employees, and you're going to have to do a whole bunch of things that, frankly, you don't have the evidence that you've got a good enough something to do that. So this is through sheer persistence, through sheer ability to articulate your vision. So all of that is what's required to start a company. And by the way, that's exactly the same thing that's required to get in to see a VC. So if you can't figure out your way, navigate your way in to see a VC, the notion is, well, you're probably going to have trouble navigating your way in to see customers and navigating your way in to see partners as well. So it's not a perfect filter, but that's part of the rationalization that goes on with VCs.
Should you settle for an associate, though, if you get kind of pawned off on an associate, or should you really be trying to aim for a partner or that kind of thing?
So first, get in any way you can. So talking to an associate beats not talking to anybody. Now, to the extent you have choices in terms of how you go in, absolutely better to be talking to a partner, because ultimately associates are just going to be gatekeepers. In the way a VC firm works is there's a small group of people that make the decision. They're called the investment committee, and it's typically the partners. And so if somebody's not a partner, they could say no, but they can't say yes. So they might facilitate you getting to somebody that could say yes, but if you can get to the person that can say yes right away, you're in a better position.
When you're sending those first emails, just trying to attract their attention, how much detail should you? I mean, should you do your introduction and try to get them interested with those background things in common network, and with just a little bit about your company, or do you try to just load the whole thing into the same email, that sort of thing?
So let me give you a little context on what a VC's life is like. So in terms of new requests, and by the way, this is my experience at Ulu, we got about 2,000 inbound requests a year. So figure there's 200 working days just to make the math round. So that means we were getting 10 inbound a day. Now, if all I was doing was looking at inbound, I could respond to that. The vast majority of my time was sitting on the boards of my past investments and working with my past entrepreneurs. So maybe 20% of my time was on new inbound stuff. And again, of that inbound stuff, most of it wasn't in the things that were just coming in like right that day, but they were companies I was excited about, and I was doing deep due diligence and so forth. So maybe 1 to 2% of my time was focused on, call it just the pure inbound stuff. And so, even at 10 a day, it's almost impossible to look through all that in a quality way. And so I've got filters. And I think a lot of folks have filters. So if it comes in from somebody in my network, I pay more attention to it. If it's in my area of investment thesis, I pay more attention to it. And I've got a few other filters that I use. So your job as an entrepreneur is to figure out what the filters are of the VCs and then target your email specifically to that. And by the way, if you've got traction in the marketplace, so traction looks like users or it looks like revenue, that gets people's attention almost more quickly than anything else. So lead with your best stuff, keep it short, and do your research. Figure out what it is the VCs you're trying to address want, and address that.
But do you do the executive summary? Do you put in what your milestone? Are you going to wait for the meeting for that, or how much other backup material do you put in that email?
All right. So I think an ideal setup would be a one-page executive summary attached to an email that's one paragraph in length.
Good. All right. We do have a. Go ahead.
So that's what I found personally effective for me. So if I read the one paragraph and I'm interested, I want to get to that one-page level. And if I'm still interested after the one-page level, then I'm either requesting a meeting or I'm reaching out asking for more information. But attaching like a 20-page business plan, I don't know that I've read a business plan sent me in that context in the last 5 years.
Okay. We do have a question from a student. How much value is there to some of the things like Angellist and that sort of thing when you're looking for investors?
So Angellist is a relatively new phenomenon that I actually think it's a great addition to call it um, the potential for entrepreneurs to raise capital. So before angels were typically in these little angel groups, and most of them, frankly, were individuals that you would have to. And it wasn't clear how'd you go find them. It's not like they have websites and so forth. So Angellist has done a great service in bringing together all these angels. So it's a great tool to raise money. One of the challenges with Angellist is it's become so popular, and there are so many people that are trying to raise money through it, that it's not enough just to basically post your company in Angellist to get attention. You need a specific Angellist strategy to be effective inside Angellist. And some of the things that I've seen work there are you find people that are already in Angellist and get them to follow you, get them to basically, sort of show up on your homepage, because there's what a lot of folks do in Angellist is there's a handful of folks that they follow, and if they're interested in a deal, or even more specifically if they invest in a deal, then that gets their attention. So Angellist is its own little kind of ecosystem, if you will, that you'll need a strategy for if you go that direction.
We have this from another student as well. Can you please help us with the process you follow during due diligence?
Okay, so there's a couple of different types of due diligence processes. So I'll start with the easiest one. So think of due diligence for friends and family. They're basically like, are you really serious about this? Or do you have conviction? And that's probably about it. I mean, friends and family typically aren't in a position to be able to evaluate the market and this sort of thing. The next step up would be angels. So angels have, I would call it, sort of more competency to evaluate your team and the market and this sort of thing. They typically don't have a lot of time, and they're doing this for fun. They're not doing this because it's their day job, as the typical characterization of an angel. So the typical due diligence there is they'll have a conversation with you. They'll rely on their past experience primarily to basically assess whether or not it's very interesting to them. To the extent they do additional due diligence, it's probably going to be things that are easy for them. They'll talk to somebody they know in the industry that, like I said, that they already know. Maybe they'll say to you, hey, show me some research on the market. So, but they're doing the sort of the easy stuff. So with angels, you typically get to the things that are most compelling to angels are often things like, well, who else is investing? And there's kind of like a safety in numbers, and they call this social proof, which, by the way, I think from an investor's point of view is a really bad strategy, but from an entrepreneur strategy, it's descriptively what happens a lot, so I would use that to your advantage. Now, if you get to the VCs, it's a whole nother step function up in due diligence. And it comes in a couple of categories. So there's a lot of due diligence that goes around the market opportunity. So is this really as big as you say it's going to be? That's one question. And the second is, are they really going to buy your product? So VCs are going to want to talk to customers, either your existing customers, and they're probably going to want to talk to potential customers you've never talked to float your value proposition by them. So that's like that's probably the biggest category of due diligence. If you've got a company that is very technical in nature and relies on patents or some sort of special technical sauce, VCs will often try to find a technical expert in that area to assess the differentiation and the protectability of your technology. And then there's the third category, which is references. So they're going to want to check you out as an entrepreneur, because if they invest in you, they're investing for potentially 8 to 10 years if you're early stage. And so they want to make sure you're the kind of person that they want to essentially be in business with. So those are kind of like the three big categories. And there's other stuff around the edges, but in my mind, those are the three biggest ones.
We're talking about due diligence on the entrepreneur, but isn't it important for the entrepreneur to also find out from other entrepreneurs maybe that this investor has put money with, what they're like to work with? Can you talk about that a little bit?
Yeah, so you should absolutely do due diligence on your investors, in particular if it's going to be somebody that's going to take a board seat. If they're just going to write you a check and not going to bother you, it's not quite as serious. But if they're actually going to have control over your company, control over important decisions like, oh, by the way, do you keep your job as a CEO? You want to understand who that person is. And the best way to diligence somebody in that role is to talk to other CEOs of startup companies they funded. And so it's perfectly appropriate for you when you start to get kind of deep in the process. So certainly after they've given you a term sheet, and maybe even a little bit before, to say, I'd like to talk to some of your entrepreneurs. And they should be willing to give you a list of all the CEOs of the companies they funded. And if they don't give you a list of all of them, that's the red flag. Now, because the incentive here, by the way, is for, these are long-term relationships through hard times. And so these are, other entrepreneurs are getting exactly the experience that you're likely to get with these VCs.
What are the questions you should be asking the entrepreneurs, though, about those investors? What is it that you want to know right off the top about the investor?
Well, so there's a couple of questions that are pretty basic. So one is, are they jerks? All right. It's a there, and VCs have, I think, not. They've got a reputation of vulture capitalists. They've got a bad reputation out there in terms of how they treat entrepreneurs. Some of it's fair and some of it's not. So I'd say the part that's not is where they say no in terms of investing. So a lot of entrepreneurs, this is their baby, and they're trying to present their baby to a venture capitalist, and the venture capitalists say, oh, that's an ugly baby. So emotionally, that's where they venture capitalists do a terrible job saying no. In terms of like the empathy, and so because they just do it so much that I think they kind of get a little numb to it. So they get a bad reputation, I think, somewhat unfairly in that category. They get a bad reputation unfairly, I think, justifiably so, when they don't support the CEO, or they're not involved enough to be able to essentially make high quality decisions. And these are definitely knowable sorts of things. So if I was talking to a venture capitalist and I wanted to really do reference checking on that person, I would talk to the CEOs of their companies. I would ask them questions like, general questions like, what's your relationship like, and so forth. But specifically, tell me about a difficult circumstance and how your VCs either supported you or didn't support you. So a difficult circumstance would be, oh, it looks like we're running out of money. A difficult circumstance would be, we lost one of our top customers, the VP of engineering left. So it's in the difficult circumstances that you find out essentially what kind of partner you've got.
And I would encourage anybody to go ahead and ask questions of Clint Korver, anything you want to know about raising startup capital. All right, so let's say you're bootstrapping, but that's not working so well, and you really need money, and you're talking to potential investors, and you really need money rather quickly. How do you try to move things along but not appear desperate?
Boy, that's tough. That's like the hardest thing in starting a company right there, because nobody wants to invest in a company that's desperate, because the fear is, oh, I put a little bit of money in, but they're on their way to going out of business, right? So I don't want to throw my good money after bad, if you will. So everybody, on the flip side, everybody wants to invest in a rocket ship. Like if the company's doing great in terms of signing up customers and generating revenue, oh, I want to invest. It feels safe. It feels exciting. So there's this unfortunate dynamic that goes on when you most need money is when you're least likely to get it. So then the question is, well, how do you sort of structure that situation as best as possible? So number one rule in startups is don't run out of money. All right, now this may be the hardest rule, but it's number one rule, and that companies don't go out of business because they have a bad product, because they can't get customers, because they can't. No, none of those reasons. Companies go out of business because they run out of money, pure and simple. That's it. Because if you've got money, now you've got the option of figuring something out. So you could say it's like, oh, we just lost all our customers. We have an interesting product. We lost all our customers. Hey, we have a year's worth of money in the bank. We can go figure out another set of customers. So we've got enough runway to figure something out. So my general advice to entrepreneurs is your goal is to live long enough to figure it out.
Okay, we have a few questions. When a competitor raises funding from a certain VC, is it a good time to try and raise money from a competing different VC?
So it's a little bit better in terms of raising money from VCs. By the way, the best time to raise money from VCs is not when a competitor raises capital, but when a competitor exits. So for example, when WhatsApp got purchased by Facebook for $19 billion, let's just say anybody that was in the texting business of any sort, got a lot more interest from VCs.
What are the main don'ts in a relationship with one angel investor or group and with a VC, respectively?
The main don'ts.
Yeah.
Well, so as the number one don't is don't, I'll put it kind of crassly, don't lie to them. All right, so long as they feel like they're on the same side of the table with you, like you're partners in building this, and it's not adversarial, now you've got the kind of relationship that is going to weather some storms. So if you've got one angel, so let's take a certain circumstance. Let's say, things are going well, but you need an extra $50,000 to kind of live these next 2 months to get to that round of funding. If you've got a strong positive relationship with that investor, you're much more likely that they're going to basically help you in that circumstance than if you've ever lied to them or you've ever and lying can be a bit extreme. So oftentimes it can turn into exaggeration. So you say, oh, we raised your money, we're going to have $100,000 in revenue in the next 6 months, and 6 months later you have $5,000 in revenue. All right, so in that circumstance, and by the way, that happens all the time where people don't hit their expectations in revenue. The question is, when do you inform your investors? So if you inform them 6 months later they're expecting 100,000 and you tell them 5, that's a real break in the trust of the relationship. So if it looks like you're not going to hit those metrics, they should be knowing along the way. You should be keeping them informed that, hey, it's not looking as good as I thought, and here's what we're trying to fix that. So we thought we could go directly into enterprises. That's not working for us. So now we're trying to go more of a consumer route. So we're working the issue. So you're basically saying, I'm being a good steward of your capital because look at all these things that I'm trying to do to hit my fundable milestones to get to the next level of the company. So that's it. So it's build. So anything, building trust in that relationship, I'd put number 1 on the list, and number 2 on the list I would put as show that you're making steady progress toward your goals, or if you're not making progress towards your goals, you're aware of it, you're letting them know, and you're consciously trying to fix the circumstance.
Okay. In the first meeting, if the VC angel wants certain improvements in product or business plan before they consider us for funding, are we allowed to ask their help to introduce us to certain contacts who can help us improve in those weak areas?
Absolutely. So this is great. So I think a great question for a VC is, what would you need to see from our company for you to be excited about an investment? So if they say, for example, well, you need to improve a few things in these 3 things in your product, that's great for a couple of reasons. So number 1 is it's hopefully very thoughtful feedback in the sense they've seen lots of companies and so forth. So I would take that seriously. Second thing is an invitation to come back to them once you've done those things. So that's, and then the third thing, and they may or may not be willing to make introductions, but if they've essentially invited you to come back after you've made these sort of 3 fixes to your product, that means they've got some interest in you. And it's actually a good thing for VCs, a good thing for them personally to make introductions in interesting kinds of ways. So if you're a company that's an interesting company, that's the kind of company they're willing to talk to if you make these next couple of steps, you're probably the kind of company that they'd be willing to make an introduction to somebody that, hey, would thank them for the introduction. So imagine folks out there that consult with startup companies, mentor startup companies that have this kind of expertise. They're always looking for the next kind of company to be associated with, and if it's a company that the VCs are potentially interested in, they're probably potentially interested in. So that's a long answer, but absolutely yes.
Okay, next question from a student is, my question is following up on targeting the VCs. If I look at current investments on their website and I am pitching in the same domain, so if they are investing in my company, won't they be compromising their investments in their current portfolio?
So if there's a direct competitor in their portfolio, the answer is yes, and they probably won't invest in you. So most of the VCs, especially the higher quality VCs, won't invest in companies that are direct competition with each other. So the ideal VC is someone who invests in your general domain. So let's say you're social networking. So they invest generally in social networking, and they've got a number of related companies, but nobody that's directly competitive. Because they're in the domain, Hopefully they'll have useful expertise that they can bring to your table, but they aren't going to be conflicted with one of their prior investments.
How do you paint yourself as successful even if you don't have your product fully developed? It's not fully baked yet.
So there's this thing called customer development, or sometimes called the lean startup, which I think is a great way to do that. So even though you don't have your product, you gather evidence that the market has a big need and that your product would solve that need. And there's this thing called a minimum viable product, and you can get pretty extreme about a minimum viable product. So just to give you where you're sort of proving interest in what you're doing. So kind of the extreme example is you say, put up a website. We have a product that does X. We make all your payments super easy. And then you drive some traffic to your website and you see how many people click on the download here button. So by the way, you might not have anything behind that. They click download here and you say coming soon, thanks, we'll put you on the email list. So now, so you get no product, but you could say, hey, we drove 1,000 people to our website and 200 of them clicked on this link, download here. So we had a 20% conversion rate on a consumer product. That's really high. And so that's evidence that the market wants what you're building, even though you haven't built it yet.
Okay, great. Okay, what are helpful ways for entrepreneurs to support the due diligence process and identify the addressable market? What kinds of references do VCs want to do due diligence on entrepreneurs?
So the main thing VCs want from entrepreneurs is customers to talk to. So ideally, this will be a customer that's used your product. And so the VCs can ask them, so what's your experience with this product? And of all the products that you use, how important is this one? So they can ask questions like that. If you don't have a customer, the next best thing is someone who you've talked to that would say, yeah, I'd buy it if they built it. So this is kind of so you're making it easy for the VC. Think about how do you make it easy for the venture capitalist to validate what you're saying. So, and let's say you don't have any of those. So then the next step is you could say, well, here are folks that we would go talk to. We haven't yet, but we would go talk to, and they're already buying products that look somewhat like ours but are inferior. So now from the VC's point of view, they can say, okay, well, you haven't talked to these folks, but I can go talk to them. All right, so you tell them, here's our target customer. Here's the person that would buy this and would see the value. And now the VCs have big networks, and so, okay, well, we'll go talk to some of those and validate those on our own. But at the end of the day, the way that you make it easy for the VC is to be really specific about who's going to buy your product, and then make it as easy as possible for them to go talk to those kinds of people. And they're going to get to the total addressable market size. So the VCs are going to take those data points and extrapolate up to the size of the market. So most VCs don't believe in, call it the top-down, where you say, oh, the payments market is a $50 billion market, and we're going after this 10% chunk, so it's a $5 billion. I mean, that doesn't really hold much water for a lot of investors, but it's more like, oh, we're selling to the treasurer of a Fortune 500 company. We've talked to 3 of these treasurers, and they're willing to pay $1 million each. Well, you got 500 Fortune 500 companies, there's a $500 million market. So it's that kind of logic, that bottoms-up logic, that's much more compelling.
Okay, last question. You really talk about using these investor meetings as real learning tools, and you say, quote, it can save you months in your company. What do you really mean by that? So this will be so let's take the good case scenario. So you're talking to a venture capitalist who is a deep expert in your area. And that means they've talked to every one of your competitors. And they've talked to a bunch of folks that you don't even know about who were thinking about getting into that industry and never did. So they've got more expertise about what other startup companies are thinking about in this area than almost anybody else on the planet. So then the question is, okay, well, how can you get some of that information from them? So let's say, I'll give you a really concrete example. So let's say you're a payment company and you say, well, we really want to partner with a big bank in order to support on the back end. And well, so if that's a good idea, there's probably 20 other people that have tried that. And let's say the VC says, oh yeah, I've seen 20 other companies that have tried that. And guess what? It's a 2-year process to partner with somebody that's like a bank.
All right, well, you might have been having like a promising conversation with somebody and you thought it's like, oh, this is going to be like a 6-month process. So all of a sudden it's like, well, okay, if 20 other folks, oh, by the way, some of them who are much more expert and are farther along than I have, their all experience is 2 years, that just saved me months worth of potentially wasted effort. So I mean that's a specific example, but the general notion here is those venture capitalists are seeing a slice of the market that nobody else is seeing.
All right, really last question. If a customer invests in your company, can it be the best way to remove uncertainties and simplify the due diligence?
If a customer invests. So I would say my first preference would be to have the customer not invest, but buy the product or service. So that will count a lot more from a VC. So imagine you got a customer and you get $100,000 from a customer. To actually get them as a customer, now they count as a customer. If they put $100,000 in as an investor, they don't count as a customer in the sense of validating your value proposition. Maybe they're trying to do a strategic partnership, or maybe they're trying to get into Silicon Valley and you're here and this is their way to start. I mean, who knows what the motivation is if they invest. But if they buy your product or service, now it's a really clear motivation. So I would say it's less valuable for a customer to invest than it is for a customer to buy. And in fact, it can actually be problematic for a customer to invest because a customer may not want you to sell to their competitors. And if they have information rights or a board seat or something like that, they may be able to influence you in ways that would limit your market opportunity. So there are circumstances where it could be good for a customer to invest, but typically that's when you're a more mature company, and when you're an early stage company, it comes with as much risk as it does benefit.
Okay, great. We've already gone a little bit over time. Clint, thank you so much for joining us, and we're hopeful you will join us again, at least in a couple weeks before the class is over. People are just diving into the course now, and I know they're going to have lots more questions as the weeks go on. Once again, thank you very much for joining us.
Thank you, Rusty, and I hope you all have a great time in the course.